Hello, everybody, and welcome to the Investing with IBD podcast sponsored by Vantage Point. It's February 23rd, 2022, and I'm Justin Nielsen, your host. And joining me, as always, is Arusha Pires. Arusha is a portfolio manager at O'Neill Global Advisors. Thanks for being here again, Arusha.
Great to be here, Justin. It would be nice to be here on better market conditions.
Yeah, absolutely. So before we get started, I just want to reiterate, we talked about this last week for the podcast. We have a survey that is out, and we'd love our listeners to help us out with some ideas of what they would like to see on the podcast. We want to get some customer feedback, how we could serve you better. So if you could go to investors.com/survey and help us customize this podcast for you, we would really appreciate it. So hope you can do that for us. And without further ado, let's go ahead and introduce our special guest. This is Scott St. Clair, the manager of MarketSmith and premium products over at IBD. And we call him the new Arusha, basically, because he took Arusha's old job. And in some ways, I think he's just riding on your laurels, right, Arusha? Everything that you started, he gets the credit for.
Definitely improving everything. It's the new Arusha with less fat, better looks, and more efficient.
More efficient.
Yeah,
Okay.
it's been super easy. I haven't had to work a day yet.
Perfect. Well, thanks for being back on the show, Scott. And of course, you can see Scott often weekly on the IBD Live show. And you have your own webinar that you do every week, the Take on the Market for MarketSmith, right?
Yeah, every Friday at the close, I do a 15 to 20-minute video on the market just to kind of keep people informed if they'd like. It's a lot like this, except just myself. So.
Mm-hmm. So do you ever get lonely just doing it by yourself?
I do. I would.
I have
like
Arusha to talk to at least.
Have guests.
Well, actually, Scott and I used to do that together for a little bit.
Before Arusha left us, it was me and him.
Well, Arusha always says he didn't leave us; we left him. So, but let's go ahead and talk a little bit about what we've got in store for our guests, our listeners today. Who cares about our guests? Right. So we'll talk a little bit about the market, as ugly as it has been. Well, also, it seems like a good time to talk about those selling rules. Now, we're not trying to go into hindsight and like, oh, see, this is what you should have done. But it is important for people to kind of learn these selling lessons about exit strategies and everything like that. So if you maybe didn't handle it right this time, you can handle it better next time. And Scott will also share with us a few of the stocks that are on his radar, what he's trading, as minimal as it might be. So let's go ahead and start by pulling up the Nasdaq Composite and that January 24th low that we were kind of looking at as, look, this is our line in the sand for the rally having been a failure. Well, we undercut that low today. So what's your take, guys?
Well, yeah. So we're back in an official downtrend. We were under pressure. This leaves no choice. You have to put it into a correction. And I think the one thing I just want to say is, a lot of times when you're in bear markets or bad markets or corrections, call it whatever you want, a number of these falter days are going to fail.
Yeah.
But you have to treat them all the same. Even though, you might think that they might fail, you have to look for something to buy. And then, get stopped out, but play really small. And now we're back in a downtrend. You don't want to use hindsight and say, see, I knew that was going to not work, because one of these will work.
Right. The one thing I might challenge you a little bit on that, Arusha, is one of the things that made this a little bit more difficult to come in with any confidence whatsoever is just a lack of setups. So,
Absolutely.
Yeah, I mean, you're absolutely right. You always have to look for things to be buying. That certainly is what helped me in April of 2020, because there was no way I believed that was going to work. But, because I had that discipline and that routine of, looking for stuff. But this time, gosh, it seemed like there was nothing out there. What were you doing, Scott?
Justin, I think there wasn't much to buy. And so, you had the signal from a market's perspective, but, the combination of merchandise, things to own just wasn't there. So even if you took the signal, you should have taken it very lightly, and the odds are really high that whatever you might have bought has probably rolled over and gotten you out. We have a new low in the Nasdaq, and the good news is that let's hope we get that second wave down, And if we get kind of a typical standard bull market based on history, this is the beginning of the second wave. And, like Bill would talk about 3 waves down. So, I really think we're probably further into the bear market than most people think. I know that the correction is on, I was at the gym this morning and saw on the CNBC or the TV, the market's in correction. And I
Right,
thought,
right.
because I think we're finally down, on the S&P 10% today. So, I've been saying over and over, the market's been in a correction, a bear market for a while. The average stock is down, a lot.
Yeah, right.
I think the stat I saw was half the stocks on the Nasdaq are down 50% or more, and then it just gets worse and worse down the food chain. So, if you're following closely, if you're looking for leadership, most people that I talk to, and most people that we talked to kind of realized that it just wasn't much to buy. And so, you're just kind of waiting on, if you're looking for technology, NASDAQ related stocks, there has been and have been some setups in energy and miners and mining and in metals, et cetera. But, maybe not everyone wants to kind of go down that road.
Well, and the other aspect here too is, and not only was there maybe not as many things to buy, as you mentioned, there were some things, especially in energy and all of those cyclicals areas that you just mentioned. But there's also this kind of concept of using the market as a feedback mechanism. And when you're throwing some things out there and you're like trying some different things and they just aren't working, you're finding the breakouts rolling over, you're not getting much progress, or the progress comes and then doesn't last, that's telling you something. And it certainly doesn't mean that you have to either be 0 or 100%. There's a lot of room in between, where you start off small, and if the market is healthy, you start adding to your positions or increasing the number of positions. But if you're not making progress, why put more money out there?
Yeah, I think it's the follow through day signal is kind of misunderstood a little bit in that regard. It's not a 0 to 100 signal. If you're cash, now you're 100% invested in a cash account, or if you're using margin, it's not a 0 to 200. If you're 0, it's maybe you go to 10% position, or if you happen to be 25% invested, let's say you're one of those really patient people, unlike me, and you've got Nvidia, or you've got Tesla or Apple or something, and you just don't want to sell it because you have big gains, you kind of earn the right. So you get a follow through day, and you're 25% invested, you might not have to do anything. You're already invested.
Right.
Wait to see if you get some feedback from the stocks you own. If they're true leading stocks, if they should be held, they should advance, and then you can start to, put more points on the board, or I'm sorry, put more exposure on the board, go from 25 to 35 to 50 or whatever it might be. So it's never all or none. I think, and I've said it 100 times, all or none decisions put a lot of pressure on you. I very rarely make an all or none decision whether I'm entering or exiting something. The only time I'll make an all or none decision on an exit is if it's hit my stop. I've ignored other signals down the food chain. So usually, by the time it's hit my stop, I've already reduced some of that stock, some of that position, because it's not acting right. So I might go from 1,000 shares to 800 to 500, and then it hits my stop and I'm out. But and then we get in the same way. I've always thought, why can't I sell the same way that we buy, right? We buy in increments. Why not sell in increments? And I've always done that because the pressure to make an all or none decision is brutal. If I like this stock, but the market's not acting well, and you sell it, now you're completely out. And what if it keeps going? So if I sell a little bit of it and it starts to come back, well, then at least I have, that portion that I haven't sold yet.
Mm-hmm. So Arusha, for you, I mean, you've got this, CMT, these letters behind your name, and a lot of people are maybe looking at where we're at now in the market as being oversold. It almost feels like you're at this rough spot because it's almost in some ways, if you haven't sold by now, you're kind of too late to sell, but you also might be too early to buy. So what do you tell people that maybe didn't take the actions that they should have previously? And you're kind of in that no man's land right now.
Yeah, now that's a great question. That's a question that I've heard many years. If you don't cut your losses at 8%, now you're down 30%, and what do you do? The sad reality is that I don't know what to do at that point, right? Because
there's no good
and
answer.
Exactly, and I had to learn this the hard way too. The first few stocks where I didn't cut it at 8%, I was in the 2000 bear market and I rode them down like 70%. Then it finally clicked to me that, oh, that's why they have that 8% stop loss, because it's really hard to know where to get out after that. So the way I look at it is learn that lesson. At this point, I don't know what you can do. Always look for some support area. For me, what I ended up doing, even when I was down 70%, some of those I just ended up cutting, freeing up the cash, and I eventually put it in stocks that were going up in uptrends, and I was able to make that back. Mm-hmm. Now, going back to that other question about oversold, when you're in really bad markets, that oversold can stay oversold for a long time, which is
and get even more oversold.
Yeah, and that's a sign when it gets pinned there at oversold, how bad that's actually negative at that point, right? It's not a positive. You go and buy it. So even things like that. That's why I kind of really ended up focusing on Can Slim, because it simplified everything, and it really just said, hey, focus on price and volume. Because if you start adding too many oscillators, too many indicators in there, you're going to get things conflicting, and it's just going to be, at least for me, it started to become too much noise that it was hard to make a decision. So stop losses, risk management has always been the most important thing. And then I've never tried to really project how far markets could go down and things like that. I just wait for the fall through day, and kind of like what we talked about. You try something, you look for something to buy. If there's something to buy, try something, try one or two things. And for those real rallies, the market will slowly pull you in over a few weeks, over a month or so. And all of a sudden you'll start to get traction. Yeah. And we didn't get that obviously this time around.
That's what I was just going to say is, you pull up the Nasdaq Composite, and there were just like these minimal things. We couldn't hold above the follow through day. We couldn't get above the 21-day moving average line. I mean, we got there briefly and then couldn't hold it. The 50-day and 200-day. I mean, forget about it. Those are those are distant memories at this point. So again, I think that there were a lot of reasons to to not get heavily invested. And even though, this was the undercut today that we got, but we had 6 days of distribution since the follow through day. So there were a ton of these situations where you had signals telling you, hey, there's something going on here.
Yeah. One last thing I would say is that it was as you mentioned there, all those distribution days were showing that chances are it's going to fail. I think the fact that we undercut both on the Nasdaq and then S&P and truly ended this kind of rally, right? We undercut the lows. Now we have to reset the count. We're back in a market, in a downtrend, a marketing correction. Now we just kind of start everything over again. We look for a count. We let day number 1, day number 2, look for a follow through day. And it just makes it a lot cleaner as opposed to the last couple of weeks where we were in this gray area where it's like, oh, maybe the market might go sideways long enough for a basis to form.
Yeah.
It's sort of. Go ahead. Sorry, Justin, but it's sort of good news that it undercut, right? Because now you've got this is how, if you study history, this is how lows are made. I don't know when the low is going to come. I don't know how, but historically lows come when you undercut lows. You get a big washout and then a huge reversal, and we just haven't had that kind of capitulatory washout. I know. It's been death by 1,000 cuts. It's like the Nasdaq goes down 1% every day, it seems. And historically, there's a day or 2 or 3 where it's 3, 4, 5%, a really bad day. that can help to, that can just wash, wash it clean sweep broom. And, then you can start looking for potential follow through day. We're probably, I don't think we're close to that, but at least now you kind of have that potential setup for another leg lower so that you can have that.
hmm Or even if we don't go lower, we just might have to put in some time. Who knows what the market's going to bring us. So we'll just have to again keep on looking at that price and volume. Look at those, wait for that follow through day, and look at the individual stocks too as our indicators. So when we come back, we're going to talk a little bit more about some of the lessons to get from this latest downturn, some of the selling lessons, and maybe even some of the shorting opportunities there might have been along the way. So stay tuned. We'll be right back. Why trade off hope and optimism when you can trade using the world's most powerful indicator? Artificial intelligence has been used by traders to navigate the markets for the past 3 decades. Visit freestockcoaching.com to see the world-leading AI forecasting software for yourself. Trusted by more than 32,000 traders, AI uses millions of data points to track market trends, giving you the support you need right now. Go to freestockcoaching.com and we'll help you find great opportunities today. Our experts will show you what stocks are setting up for big changes right now. So head over to freestockcoaching.com for a free demo. Trading involves financial risk and is not suitable for all investors. Past results do not guarantee future performance. Okay, welcome back to the Investing with IBD podcast, sponsored by Vantage Point. It's Justin Nielsen along with Arusha Peiris, and our guest this week is Scott St. Clair from MarketSmith. So, Scott, one of the things we do a lot around here is the whole post analysis, and in doing kind of your own post analysis of this latest downturn, what are some of the things you feel like you did well? What are some of the things that you wish you had done a little bit differently? Again, hindsight is 2020, so this isn't the idea of, you should have done this. This was obvious, but were there parts of this that were obvious and maybe a little bit easier for you to handle just based on your experience?
Well, a little bit. I think if you study history, then you're always flexible and open to the idea that this can happen.
hmm
So, I started in 1995. So I've been through the long-term capital crisis management, the
Right.
2000 bubble, the great financial crisis, COVID. It's just the market just continues to amaze me, which is why it's so much fun, but so difficult. So I'm always of the belief that the stocks can do anything. They can go up. Tesla, it can go up 20-fold or whatever the number is, and then it can go down 72% because that's what stocks do.
hmm
I know a lot of people think they get stuck in these types of things. So, but one thing that I've done in the last few years, at least, is I just kind of stay with what I do best. One of my favorite quotes, and I hope I don't butcher who quoted it, but it's from hedge fund market wizards, is do more of what works and less of what doesn't.
hmm
And I think it was Scott Ramsey, but I know it's the book Hedge Fund Market Wizards by Jack Schwager, which everybody knows.
So
And
Scott, well, let me stop you there. How did you figure out? How long did it take you to figure out these are the things that I do well at versus these things that I'm just going to get rid of those?
a long time,
Yeah,
Arusha. A long time.
yeah, no, yeah.
I mean, how much time do we have?
I know.
It's crazy. I don't know if I've told the story on a podcast, but I think I've told on IBD Live. But the first time I went to the Kansas Masters program and Charles Harris spoke, and he said, I've never had a long-term capital gain.
Right.
And the room there had to be 200 people in the room, and everybody just roared with laughter except me, because I was like, oh my gosh, I've never had a long-term capital gain either, because I've never held something the 12-month window or whatever. And it was very enlightening for me, because I was like, here's the guy, Charles. He had shown his track record, and, he runs money for William O'Neill. He's a portfolio manager. And that at least what I could observe from him, we traded, sort of similar. So that was, that was a relief, because I've always kind of felt like, gosh, how come I've never had an Apple or a Google or, some of these pick and save like Bill has. And it's just my personality. I just get wiggled out along the way. It's they just don't go up in a straight line,
Yeah,
unfortunately.
right.
If a stock goes from 100 to 200, you think, well, that's 100 points, but it probably moves 500 points if in that
Yeah.
in that
Yes.
move,
Yep. Yep.
and it just somewhere along the lines would get me. So I've just always been a seller, at least trimming into strength. I just been doing it, and I know in 2017 it hurt me because the market would just stair step, stair step, stair
Mhm.
step, and I underperformed. The Nasdaq that year, I think the Nasdaq was up like 30 some percent, and I was 500 basis points less than the Nasdaq or something. I was less than the market because I
Mhm.
would trim, and the one thing about the market, it's always fully invested, right? So
Right, right, yeah.
so if you have sell rules and you get out because you get a sell signal, and the market comes back, but you're under invested, so to speak. So in the last few years, I've just gotten comfortable with it. This is what I do, and I underperform. That's that. I'm okay with it. And in 2020 was fine because there was so much merchandise. I could get out of something and move on to another name. So that didn't hurt me like 2017. But this year, having sell rules, and partly, I think, really honestly, in the last half of last year as well. It might not seem like it for the indexes, but the markets, the turbulence, the problem with the market has been a long time coming.
Mhm.
Mhm.
And so, you're like the boy who cried wolf if you have a sell rule, because,
Right.
the one thing about having a big winner, if you're going to hold something like an Nvidia or Google or something, you're going to have to ignore a number of sell signals along the way
Mhm.
Right.
until the final sell signal, which works, and then it's like, well, how come I didn't get out? Well, you didn't get out because you ignored some of the other sell signals along the way. So I would just rather not ignore it, knowing that I can always get back in. Maybe it's going to be or probably at a higher price, but I'm okay with that. So I just do better like that. So I've just found that if I don't, let's say I buy something at 100 and it goes to 130, and I'm just going to be a seller on the way to 130, because I've reviewed and looked back and found, like, let's say it went to 140, but there was a sharp break in the market down to 125 or something. A lot of times I was selling at 125.
Yes. Sure. Yeah.
I was getting scared,
Right.
so I was better off taking 130. That was a better price in the long run, and you can stack those on top of each other.
Mhm. And did you just kind of do an analysis of all of your trades, or did you just kind of go by feel? Were you looking at hard numbers? What kind of finally convinced you, hey, this is what works for me?
I think there's a lot of personality in there. I just think it was what I was most comfortable with. Also, I might have been trained to do that because for a longest time, this is the first kind of real job I've ever had. I was a stockbroker for a lot of years, but it was strictly, commission based. It was old school commission based business. You eat what you kill. And I started to get some money in the market and was doing this, and really was making my living from the market. And so when you're doing that, you kind of get in this mentality of you got to make money every month or every
Hmm.
quarter. Uh, and so you just develop these habits of, I've got to always be in the stocks that are moving. I can't afford to sit through a base. So if I think the stock's, short term extended, I would get out and look for the next name. And so, some of that is just kind of a little bit of personality, but some of it, maybe it's just a lot of years of doing that. And so I've tried to retrain myself, and I've gotten a little bit better. Partly one of the reasons I wanted to come work at William O'Neill and Company and IBD is kind of get back on that bike to, maybe uh, relearn the rules and unlearn some bad habits that I had.
Hmm.
Yeah, Scott. Now, one thing that, and we've known each other for a long, long time and worked very closely together for a long time. One thing that I was always impressed with you, especially when these markets were starting to turn, you were able to shift that mindset to going long to going short, and you did it again this time around. How do you manage that balance? Because I've always found it really hard to switch, and so the for me personally, and this is one thing that took many years for me to learn, is for the most part I'm kind of more long only. When the markets get tough, I'm going to go mostly the sidelines. Maybe I'll do a little bit shorting of the indexes and stuff like that. But how do you balance that by going long and then shift that mindset to now you're going to short?
Yeah, it was experience. Kind of the time frame that I came up in the markets. I started in 1995,
Mm.
and if you look at a monthly chart of the Nasdaq, it's like, oh my gosh, just
Right.
started right. I opened my own personal account in March of 1995, and it was just
Yeah.
nothing but up.
Yep.
So I just was trading and trading, and man, I was an active trader. I was really, moving around full margin all the time. Sometimes, the story, Risha,
Yeah.
sometimes more than full margin, because back
Yes.
then they
Yes.
didn't have the checks and balances that they do now. So
Right.
I would literally go home 4x stocks because
Uh-huh.
I didn't know any better. That stock looks great. Why do I not want to own 4 times my account in it?
And I'm
And you
sure at
could
that point your salary was basically paying for your commissions.
I was my best customer as a stockbroker by
Right.
far, by far.
Uh-huh.
It was, yeah, because back then you had to, pay commissions. So I was very active doing this, and I was, like I said, I was making my living from doing this. And then in 2000, just dumb luck or whatever, but I was able to recognize that, not at the top, but I just knew that it was a bubble. I know that sounds crazy, but I did. And it just was a matter of, I just knew I was making too much money. The people around me were making too much money, and it was going to end. Now, I didn't know it was going to go down 90%, but I knew it was going to end. So in
Mhm.
2000, I started getting short because I knew that it was going to end, and I was a student of history. And I thought, history says this can go down a lot. There's potential for it to go down a lot. I made the most money I've ever made in my life in 2000. Not the greatest percentage wise, because I had a little bit more money in 2000 than I had in 1995. In 1995, I had the greatest percentage I'll ever have.
Mhm. Mhm.
But I made the most money in 2000, which has been a blessing and a curse, to be honest with you, Rusha.
Yeah. Yeah.
Because when you get the short side right, it's fast, it's furious, and and you can get, the Nasdaq's not going to be up 6% one day, unlikely, right?
Right.
But when you're in the short, in an environment where the market's in bad shape like it is now, it can be down 6%, or something. And if you're short, the names that are high beta, high alpha stocks, they can be down 10, 12,
Right.
15%.
Yep.
So I made, that feeling of being able to make that kind of money. Like I said, honestly, it's a blessing and a curse. So um, I've just had that kind of switch where, I want to, I know I like, oh, you can make a lot of money from being short, but it's, I've also learned that it's, there's been I've had my worst days in my trading life from being short, um, overstaying my welcome.
Mhm.
So I was short Fannie Mae, and the government came out, and I don't even remember what the news was, that you weren't allowed to short stocks, or they were going to backstop it, or I don't know what the news was, but I'll never forget watching that stock go up 20% in about an hour.
Oh, jeez.
Yeah, and I was
Uh,
frozen the whole way.
uh,
So you have to, the short side's a very difficult animal, but I think I developed this the style and the strategy, and the is it probably would be from 2000, from
mhm. Yeah.
trading that 2000 top.
Well, now to put that into present day, what we had here, and this is fairly common. You don't go straight down a lot of times. You'll come down. You'll have these rallies, and you really have to kind of gauge this concept of when does it become too obvious? When is the pendulum shifted too much the other way? So maybe you could walk us through, and maybe you could use a individual stock if you want, or maybe just use the Nasdaq to kind of talk about some of these concepts, because I know one of the things I've really respected on IBD Live that you've done is you've been very spot on in terms of, hey, this is where I'm covering my shorts because now it's now it's a little bit too obvious. We're undercutting these lows and so on. So could you walk us through a little bit of the present day on how you've been handling things?
Yeah, one of the things about shorting that's even so difficult too is that you can't turn the charts upside down and say, okay, it's breaking out of a reverse cup with handle. That's
Hmm.
the time to short. That's not the time to short, in my opinion. That's the time to start covering. So you need to short into strength, which is very difficult because you're shorting into strength, and there could be a couple of days where you have to learn to endure a lot of pain.
Mm.
Because if the market's up, if I'm shorting into some moving averages on the Nasdaq, like it's rallying, I might, if you're a day or two early, you could be down 2, 3, 4% on the indexes, and if you're on the individual stocks, it could be worse for sure. So that's what makes it hard, is you got to short into strength, and then you need to cover on weakness when it looks obvious. So like now we're undercutting the lows, and maybe today might be one day too early, but like I only have one short left as we sit here because I've covered shorts. For the last 3 days, I've taken off names into the weakness. So tomorrow, like if we had like a really bad washout day, then I probably won't be short anymore. So you,
Hmm.
you can't you have to, when it's breaking these lows right here, it seems like, oh, that looks like a short, that look, we're breaking support, but my experience is that's when you can get run over. So you have to be careful of shorting like that.
You almost have to kind of just go against your emotions at that point, right? Where you're seeing, like, today is a perfect example. You just kept seeing the market getting worse and worse and worse, and you're like, oh, it's breaking support. This is the time everyone's going to give up, and it's just too late. That, because I found out the hard way where I used to do that. It's like it would, right here would be where I'd short, and I just get run over in a few days. I'm wondering why is it not going? It broke support.
Yeah, I was, with about a half hour to go, I thought, man, the market's gonna close on the lows. We're gonna cut the low, and my thinking is tomorrow's gonna be a bad day, and I want to be short. So I pulled up. I was gonna buy SQQ, which is the reverse of the Nasdaq, for my IRAs. It's triple reverse, right? And because an IRA, you can't go short. If you want to be short in an IRA or a Roth, and I do, I sometimes feel like you have to use these inverse ETFs. So I pulled it up and was about to put the short on because I'm like, this this is going lower, and I didn't do it. I didn't pull the trigger because it's like it goes against everything I've just said.
Hmm.
It's the time to be short was 2, 3, 4 days ago, before you get this wash. Now, could it be up $1 tomorrow or something like that? Yeah, but I want to deal in probabilities and the risk reward. And so to me, the risk reward wasn't skewed in my favor by taking the short now, even though I feel like we're gonna go lower.
Hmm. Now, how do you kind of put into all of this analysis the whole geopolitical, the rate hikes, the wall of worry that's going on out there? It's that something you pay attention to at all, or are you just really looking at the charts?
I don't want to say I don't pay attention because you can't help but notice it. Like
Hmm.
on Twitter, I like to use Twitter for sentiment. I like to see if people are talking about the stocks I own, because if they are, then I want out, because then I know that a short term wiggle it could be likely, and so I'm aware of what's going on. But wow, you talk about above my pay grade, it's just totally impossible. So and we'll talk about it maybe in the next segment, but I am long gold, and there must be some, obviously the geopolitical tensions, there must be something built into that price. I've been long it before this occurred, and so I felt like it was going up before I kind of, knew what was going on in Ukraine. But I can't ignore the fact that some of that strength has to be attributed to that, and that if the tensions were to end, what would happen to
Mhm.
gold?
Mhm.
I know that it probably would be down. So then I have to say, okay, I kind of think, well, how much would it be down, and can I handle it being down? And so, yeah, you have to think about it. But most of um, my analysis is just going to be, price and volume and the narrative. And the Fed is an important narrative for sure. It's one tier lower on my pay grade as far as Ukraine and Russia. I might know the understand the Fed a little bit better than that, but the Fed is an important, huge factor in stocks and has been my entire career. And Marty Zweig, don't fight the Fed is one of the first things I learned.
Mhm.
When I think even Bill has it, the quote in
Yeah.
his book. So I've been negative and to this because as the backdrop, prices are going down, and the Fed they just doesn't look like they're going to capitulate just yet. Now, at some
Right.
point, they might capitulate, and then you have to change, kind of like with the whole 2020 and 2018, the Fed
Exactly.
taper
Hmm.
tantrum and all of
Right.
that. You have to be aware of it, but you don't want to be. I don't want to try to guess what the Fed's going to do, and I definitely don't want to try to guess what is going to happen in Russia slash Ukraine. Uh, so I'm just going to go with kind of what they say. The Fed says they're going to raise rates, so I'm going to, until I see action that tells me, wait a second, the market's acting contrary to what they think the Fed is going to do, then I'll just keep that in the back of my mind as part of my playbook.
Hmm. Well, when we come back, we're going to get a little bit more into what your playbook looks like right now. So make sure you all stay tuned for that. We'll be right back. Kicking yourself for that early exit? You can prevent them, and it's easier than you think. Go to freestockcoaching.com to see the tool independent traders are using to perfect their trades: artificial intelligence. AI doesn't involve staring at your screen for hours, and no research is needed. Just pick a stock and press a button. Visit freestockcoaching.com to see a live demo now. You need to be ready for rapid market changes, and AI can help you avoid potential losses. Check out freestockcoaching.com to learn more. Trading involves financial risk and is not suitable for all investors. Past results do not guarantee future performance. Okay, welcome back to the Investing with IBD podcast, sponsored by Vantage Point. It's Justin Nielsen here, along with Arusha Paris and our guest, Scott Sinclair. So, Scott, before the break, you were talking a little bit about how you had a position in gold. So, maybe we could start with GLD, which is an ETF that kind of goes over the spot price of gold. Why this one? And do you look at the gold miners too, or is it just really about the price of the commodity itself here?
Well, mostly it's going to just be price action. It's going to be like 90% of my analysis. Like I mentioned previously, from a macro standpoint, it's very, very little goes into my decision making. But the price is just acting abnormally good. Gold has gone up and gone down and gone up and gone down and wore people out, and so maybe there's a possibility that it can go up a lot, right? And so I want to, as a general rule, with everything you buy, whether it's gold or Twilio or Google, you want a chance to make a lot if you're right and lose a little if you're wrong. So the relative strength line is really shooting up. The relative strength rating is 86. I was for the break here. I think we were saying I don't think it's ever been that high. I don't know for sure, but I would venture a guess it's never had an RS rating of 86. Now remember, it's relative, right? Because since everything pretty much is going down, and gold is going up a little, it's relative to everything else. It's really shooting up. So I just I think there's a potential for a huge move here. And if I'm wrong, and barring a gap down where I can't honor my stop like I'd like, I'm risking a little to make a lot, and that's what you should be doing all of the time, whether it's gold or XYZ or any of the other stocks that I mentioned.
And can we just define what to you is a lot? A move for gold here.
It's a good question, because I'm going to, if it ran to 2,500, I would be out way before that. But I'm also using a much larger position size than most people. Like for me, a normal position would be 10% of my portfolio. I'll even go to 30%. I don't go much further than that. I think a few months ago, I can't even remember what it was. Oh, I think it was CF. Anyways, I was at almost 40%. I don't remember if it was CF or not, but it just made me really uncomfortable. And so that's the kind of feedback I need to know what the right position size is. So this is a pretty good size position. And for most people, 10, 15, 20% is just unheard of. They would never do
Right.
that. But I've been doing this a long time, so I'm super comfortable in that kind of sphere of exposure, because I know that I'm going to get out quickly if I'm wrong. So I have one of my favorite sayings. Another one I know I mentioned I'm big on sayings, as Arusha knows, is I have it pasted to my board everywhere. It says courage, patience, imagination, and execution. And the imagination is really imagine that it can go up a lot. Like I have, if the people that made so much money in Tesla, they really imagined that it was going to do what it did, right? And so you have to kind of have this imagination that it can go up a lot, or the opposite, that it can protect you as well.
Yeah, right.
If you have the imagination that it can go down a lot if something goes bad. So I would say, 20, 25%. If I captured that with the position size that I have, I would be really, really happy about it.
No, I mean that can definitely add up to a lot. Now, Scott, with gold here, at least with the GLD, what was it? Were you entering it as it was getting past that 173 area, that short-term resistance within the flat base?
Yeah, and 211 is the day I entered the trade, and I own calls. I own options.
Yeah, that's what
So
that looks like. Exactly what I
I'm
was
even
thinking.
more,
Yep.
levered to the price when you own options. So, yeah, that's the day,
Yeah. Okay.
211.
And maybe you could talk a little bit about this long base that's on the monthly chart. So some people would look at that and say, hey, this is something that just hasn't gone anywhere for years. So what to you makes it look like, hey, now's its time to shine?
They are right. Yeah, that hasn't gone anywhere for years, right? And it's basically at the 2011 peak. GLD topped around 185, and here we are at 178. So in the last 11 years, it hasn't exceeded that high. But that's the idea, that maybe it could take off from out of the space. I like to look at monthly charts a lot when I'm buying something, because if it's coming out the beginning of a long sideways price action, maybe something has changed, right? Like if gold is, if all of a sudden it's using GLD as a proxy, 180, 185, 200, the market is telling me that something has changed, and so there's possibility that change could be really huge. So that it hasn't gone a whole lot, but all the relative strength is starting to turn up, and that, the rating is much higher. So I'm thinking that that maybe there's a setup here that it could be more timely, especially if I'm going to use call options. Right now they're long dated. They're all the way out till August or July of this year, and I can always roll them if I want. But anyways, yeah, I need a catalyst, right? And so the catalyst would be bear market, and that maybe we're in, or Fed tightening cycle that goes awry. Anything could happen. Nothing I could ever predict. I just have to be there and follow the price action.
Yeah, well, I mean, it's gone up. But if you look back like at 2019, it's gone up like 50, 60%.
Right.
And over the last year and a half, it's held most of those gains. So there is a little bit of a character change here. And then you look at the larger part, it could be breaking out of this monster cup with handle.
And gold is, if you follow gold at all, it's just disappointed people forever.
That's true. That's true.
Even the gold bugs hate gold,
Yeah,
So
exactly.
And so that appeals to me a little bit. The contrarian in me is like, gosh, nobody likes gold. Bitcoin's the new gold, and so it's like, if nobody likes it, why is it going up? And that appeals to me. But it's a little bit off the reservation from what we normally do. The can slim. There's no earnings. There's no sales. It's a pet rock. Believe me, I know all of it. I know all of it. You don't have to at me about it. I understand. and if it goes down, I'm going to get out and take a small loss. At this point, maybe I could lock in a small profit or something if it doesn't work. So I get it, but that's what appeals to me, is the potential for a really big move, based on the fact that nobody likes it and the price is moving the wrong way. Somebody's pushing the price.
So in kind of a similar vein, maybe we could take a look at EWZ. Now, this is a Brazilian ETF, so it's kind of keeping track of Brazilian stocks. It's an index made up of Brazilian stocks. And this is another one, if you kind of go back to the monthly chart on this, this really hasn't done anything since the great financial crisis of 2008. It's kind of been in this long-term consolidation. And I mean, I remember before that, you had all of the buzz was about the BRIC nations, right? So what's attractive to you right now about EWZ? Because this is another one that you said that you've been following.
Yeah, I do own this one as well. And I have an analog that I came across that makes me think this could go on another long move. And it's an ETF, so it'll be a little bit slower. I've got to temper my enthusiasm for normally how I trade. But if you look at EWZ right on a weekly chart, and okay, great, thank you. This is week 7. Today's Wednesday, and if you backdate a Nasdaq chart to, let's say, May 1st of 2009, the start of this massive, I guess, cyclical bull market we've been in, that maybe is ending. The Nasdaq did the same thing, went 2, 4, 6, 9 weeks up in a row.
Yeah.
And then ran right into that 40-week, right where, if it's a bear market rally, it should lose steam. It should get hit right there. Right. You can also see the 3 waves down, which is perfectly displayed here, from 2155, you rally, then you 1295, you try to rally, and then you undercut that low, which is that 3 waves down I mentioned earlier. But you run into a little bit of resistance here, but then you go on a long bull market. So, commodities and these areas have just been way underinvested, way underexposed to capital for years and years and years. I saw a chart of, tech spending and CapEx for tech and CapEx for commodities. It's the old alligator jaws. And so it's a risk reward trade. I think if it's the start of something big, I can risk a little to make a lot. I don't even think it was down today. It was up 6 cents today. So as the market's getting hammered, it's just kind of sitting there refusing to go down.
Yeah.
And so that, if you're going to play, and I like to play, I take this seriously. I don't know if play is the right word, but I love the markets, and I have a hard time stepping away sometimes. So I'm always looking for areas to be invested. And so if you're going to be invested, you can't be in the Nasdaq right now. That area is just under fire. But there are areas that are holding up or trying to.
Okay, so let's go ahead, and now this isn't necessarily related, but we'll go to Rio now, which of course is a metal miner. So Rio Tinto, this is a UK-based company, ticker symbol RIO. This is another one that, again, a lot of these cyclical names have been where the action has been lately. So walk us through a little bit of what's attracting you to Rio.
Setup, you actually have a pivot point you can buy if you want to. There's a really large cup with handle here, but the relative strength, is the RS line is almost new highs, and the RS rating is 88, and it's just outside that universe of tech. And so if this market gets really bad, if we go into a longer term downtrend, there's a lot of money out there, tons of it, that has to find a home.
Mm-hmm.
We don't always, like, if I'm running my own money, I can be in cash if I want, or I can be 20% invested. I don't know what Arusha's mandate is, but I know some of his, I would imagine some of the institutional money he runs, he can be on the sidelines, but very few people have that luxury, in the institutional world. So
Right.
some stuff will hold up, and it'll try to, and money's going to go where it's treated best. And if this area, if we're in a long potential boom, if history repeats, in 2000, tech topped, and what happened, right? You had a huge emerging market boom, commodities boom, the potashes of the world went crazy. So you could have that type of potential setup. And so if it's an area where, if you're looking to put money to work, it seems like the money's being treated best in these ones.
Yeah, I just pulled up the monthly chart in Rio, and it looks like it's, setting up to emerge out of a monster base here too.
Yeah, it's probably, I don't know if it's ever been, maybe, yeah, it was in the 80s in May of
Right. 2008.
2007, right before the crisis, 2008. Yeah. So again, if the market's telling you something, when it, partly go back to Bill's, all-time highs, when stocks or markets or whatever it is, when they make a new high in price, it's a signal that something potentially has changed, and it's the toughest signal to take, because we're not used to that price. I find that I see that people want to buy stocks on the way down, and as hard as it is to believe, I think, in even the statisticians, there's a guy I follow that I read a couple of his books where he proved that stocks are actually safer at higher prices. So it's crazy to think that, but
Yeah.
Tesla was much safer at 700 on the way up than it is at 700
Right.
on the way down.
That's an interesting way to look
So
at it.
when Tesla first made its the first time it ever hit 700, there was a little risk, but a huge potential runway. Now it's the reverse. I see people that want to buy this on the way down because they love the company, etc.
They can
But
get it on the cheap now.
yeah, it's so much more riskier here at 700 on the way down than versus on the way up.
Yeah,
So
I should mention that I do have a tiny amount of Tesla still, just trying to get a feel for it, and it's not a very good feeling right now.
and a lot of people do, which is, yeah, a lot of people. Charles, I don't know. I assume he still has his position, but I think Tesla, if we're going to go down the Tesla road, is the poster child for this bull market. Such an important stock,
For sure.
and it's been a very good barometer for me for trading the markets, because I watch that one closely and I'm in it a lot, usually on the other side of everybody else, which is short. But when the last few months, Tesla has not been able to rally and so it's told me that, if Tesla can't go up, then nothing's going to go up. And that's why you should be following these leaders.
Yeah, I think that's a really important concept for everyone to hear is, watching those leaders and how they behave. I remember even with Google, when they reported earnings and they had the earnings gap and it was breaking out of this consolidation past 3,000, that was one that I was watching very closely to see how are they going to treat one of the big stocks in the market after a good earnings report. And we found out very quickly they're not going to treat it well. And so that was telling you a lot about the overall market right there.
There's a lot of wisdom in watching stocks that are leaders that you don't own.
Yep.
Yeah, right.
That a lot of people don't realize how much feedback you can get from I almost said Alphabet. I always call it Google, but Google, Nvidia, Tesla, Apple, Facebook, PayPal.
Yep.
And you go all the way back to December. I was looking, December 3rd when DocuSign blew up.
Yep.
And that was December 3rd of last year. That was a really bad omen for the market. That stock was down 40% on a gap in one day.
Yes.
And so when you see that, you should say, "Whoa, wait a second! That's unusual price action the wrong way. Maybe there's more risk in the market than I see." Because at that very moment, the Nasdaq and especially the S&P is probably pushing brand new highs. Yeah, the S&P was 4,700, on its way to 4,800 when that happened.
Yep.
So and these are things that you can learn them the hard way, which most of us will do.
Right.
Or you can go back and study history, which will help. But in my experience, you'll still have to learn it the hard way, and you're going to have to learn it the hard way more than once. Unfortunately, I don't know why I've made all the amateur mistakes more than once. You'd think, well, one time should be enough, right? But
I wish that was the case.
Emotions creep in, and this time will be different. Famous last words.
I don't know. It doesn't seem to be, but there's two ways to learn, and the cheaper way is to study history and see what's happened before and try to learn from that.
Mm-hmm. But maybe the one that sticks with you is the one that hurts the most. So
well, you feel it more which is why I'm a big proponent of skin in the game, of being in the markets, of if there's a follow through day and you're at zero, put on a small position, because I just think the feedback is so much exponentially greater when you have a position versus paper trading or just watching, or I just find I just don't feel it have that same feel when I'm on the sidelines.
Mm-hmm. Well, great advice for people, and a lot of lessons to kind of learn from this. So thank you very much, Scott, for showing up on the show again. So always great to have you.
Thank you, guys. We'll see you later.
Okay, wonderful. And next week, keep in mind that we are going to have Pedro Palindrani back on the show. He is a research analyst at Global X ETFs. Last time we got his take on infrastructure and EV, lithium plays, and all of that, battery technology. So it'll be interesting to check in with him and see what kind of thematic investing he's seeing on his horizon. So make sure you come back for that. Thanks for watching today, and we'll see you next time. Make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.